Candlestick charting patterns are very, very important. They repeat, they repeat, and they repeat, and you need to learn to recognize those to spot the best trade opportunities. Today I'm going to talk about 2 patterns you should be looking for, as well as 2 you should focus on avoiding. Hey everyone, lead trainer with StocksToTrade, Tim Bohen here. Be sure to subscribe to our channel and also please hit that alert button. We release a lot of great videos and we go live. So every time we go live, I want you to be able to jump in there, see that Q&A, and be notified. So hit that alert bell. Well, in trading, you'll hear patterns, patterns, patterns. Everybody talks about, hey, look for this pattern, look for that pattern. You might be like, well, that's great. I'm glad you're telling me to look for patterns, but what do I look for in a pattern, and what is a pattern? So I've got 2 that are bullish patterns, something that you should look and be scanning for every day and look to go long. And then I've got 2 patterns that you should avoid that, in my opinion, sucker in a lot of new or intermediate traders. And something I say a lot, and write this down, I think it's a great trading rule, one of the most understood or underweighted trading rules is knowing what not to trade. Okay? There's 16,000 publicly traded stocks out there. Every day there's hundreds of them that are moving, and I think if you can recognize bad patterns, bad setups that keep you out of those losses, that is a greatly underrated skill. So that's why I want to talk about 2 that you should look to avoid. So I'm going to start out with the bullish uptrending chart. And remember, these are examples. You don't necessarily have to focus on the ticker, but we're looking at the pattern. And in this instance, I've got end phase on screen. You can see it as a long history of kind of consolidation. And then starting right about here, it broke out on high volume and a big daily candle. So if you haven't watched some of our past videos breaking down candlestick patterns, I might get into a little bit of a jargon in this video, but go to our library, check out the introduction to candlestick patterns, the content's there. So if you're like, hey, what's he talking about? We cover all of it. So big high volume breakout. Then notice how it just gradually uptrends. And these are where you want to draw your trend lines. You're looking for those higher lows and higher highs. So those candles are opening higher and closing higher. That's your gradual uptrending chart. And you can see that end phase gapped up on big volume, gradually uptrended for 4 months, gapped up again, and has been gradually uptrending for 3 months now. Would you want to be in this stock? You know, back here? I think I would want to be, riding this nice, slow moving, grinding up stock. It's up almost 250% in roughly 6 months. That's the kind of chart you want to look for. Gradually uptrending, breaking out on the 52-week chart with building volume, higher lows, higher highs. Next one we want to look at is a consolidation and breakout chart. So you can see this stock, ARQL, is one we've talked about previously. What I like about this stock is it tends to gap up, consolidate, and then re-break out. So you can set alerts in StocksToTrade or whatever platform you're using. So if you miss these big gap ups, you can just set an alert at that next breakout area. So for instance here, this big high volume candle, it gaps up, stock goes into consolidation mode. When I talk about consolidation mode, it's in a tight band. Stock is just tracking sideways, and it's coiling, we call it sometimes too, where it's not breaking out, but it's also not breaking down. That means that stock is collecting buyers, it's building momentum, and it's holding its gains. So now everyone is looking for that next breakout area. Then you can see big gap up, runs, consolidates, big gap up, runs. Now it's back in consolidation mode as today. This is a top watch for that next breakout level. You're looking to buy those breakouts with risk. You set your risk on the failed breakout level. No, not every trade is going to work, but these are consistent patterns that repeat. And if you've got a trading plan, which I talk about all the time, you can risk small for big potential gains. So something like this pattern, you might be risking a few percent and be making 10, 15, 20% when the trade works. Okay, two of my favorite to watch, the bullish uptrending chart as well as the consolidating breakout chart. The two I want you to avoid, and as I mentioned in the beginning, this is important. I think many newer traders get trapped in these terrible patterns, and then they get frustrated, they become bag holders, and they think trading doesn't work. So this is one, Blinn. This is a stock a lot of traders literally today were talking about in pre-market. You know, everybody was abuzz, they had a contract win, it was up in pre-market. Now, as of right now, it's about to go red on the day. Now, how did I know to avoid Blinn? There might be no better example in recent memory of a long-term downtrending chart. Notice, this stock has done nothing for a year but go lower. Every single time, or every single day, it just trends lower. And when it does bounce, it closes on the low of the day and continues its trend down lower. Never, ever try and trade these what we call dead cat bounces, okay? This stock, until something significant happens, should be avoided. And any time, if you bring up a daily chart that looks like this in pre-market, please take it off your watch. Don't try, especially as a new trader or intermediate trader, don't try and trade these patterns. So many of them fail. The risk to reward is just not there on the long-term downtrending chart. Last one I want you to avoid is what is called the one and done. This is a chart that the stock spikes, but then puts in those doji candles. If you're not familiar with doji candles, again, check out our other videos where we break it down. But you can see every time the stock spikes, it spikes and then closes almost on the low of the day. It did it here, it did it here, did it huge right here. Look at this candle. It ran from 9 to 17, closed it back in the 10, and then the next day got destroyed down to the 6s and then faded, and then again did it again. Here, went from gapped up to 13, went as high as 16, closed under 12, and then the next day got destroyed. Second day, it was already down to the 8s. So avoid these doji candles, avoid these what we call one and dones. When a stock can't put in more than 2, 3, 4 days in a row, it's an avoid. Now you might win here and there, but they tend to squeeze, drop, stop you out, and create frustrating losses. So remember, write this down. The bullish uptrending chart, the consolidation breakout are the two I want you to focus on, and then avoid the long-term downtrending as well as the one and done chart. And drop me a candle below. Are you trading these patterns? And particularly, have you gotten suckered, for lack of a better term, into buying that long-term downtrending chart? I see many traders who think they can buy at a discount. So let me know, comment below. Have you traded, have you gone long some of those long-term downtrending charts? Thanks for watching our video. Be sure to comment below with any trading related question. We love answering your questions. Also, like and share with your friends, and be sure to subscribe to be notified as soon as our next video hits. And if you're looking to expand your trading knowledge, don't forget to check out all of our other videos, and be sure to click the trial below. Check out StocksToTrade. I think it is one of the best, most rapidly advancing softwares out there. Be sure to check out our trial.